Hi, good morning, everyone. We'll start the webinar now. So we'll have some update on land transport, as well as some of the company results and update on policies from central bank meeting. Our banking analyst is not in office right now, so we will not be covering the slides for banking sector as well as DBS. Okay, so first, land transport. We published a sector report last week. We're maintaining overweight on the sector on the basis of positive industry structuring following the exit of Uber. And the worst is over for the taxi industry. As you can see, ComfortDelGro is starting to buy new taxis already. We maintain accumulate on ComfortDelGro and unchanged target price of 269. Last close on Friday was 227. So this is some of the news. We'll start with a data point. So for LTA side, they have published some of the data. That is taxi and rental car population, as well as the taxi driver vocational license statistics. So for taxi-wise, year on year, the population is down almost 18%. Year to date is 8.5%. And month on month is a decline by 0.3%. For rental car wise, for the month of June, is 8.8% higher year on year, but the growth has been moderating. So year to date, it's only 1.1% growth since December 2017, and month on month wise, the rental car population has increased by 0.7%. This is the number of taxi driver license holders. So year on year is down by 2.1%, but year to date since December is there's a slight increase of 0.3%. Likewise, month on month 0.3%. So that implies that as of May, actually it was flat year to date. So for the number of licenses issued, you can see that there's been a big jump year on year. In June this year, there were 344 issued compared to only 133 in June 2017. On a cumulative basis, for the first 6 months of this year, there was 2,019 issued. That's almost double of what was issued in the first 6 months of last year. The other piece of news is that a new entrant, Tada, has launched its ride-hailing app, and that app uses a blockchain to keep a record of rides. The other news is that ComfortDelGro will be buying up to 1,200 new taxis. So this is, if I give you a breakdown, as you may recall, they have already purchased 200 taxis, and then they have put up a tender to purchase another 500 more. So this 1,200 will include an option for another 500. So that's 200 plus 500 plus 500. So the positives, although I'll talk about them in this slide, but in the subsequent slides, I'll show you the charts so they can visualize what I'm actually saying. First one is a decline in taxi population shows sign of bottoming. Rental car growth continues to taper down, and it has reached a single-digit growth rate for the first time in 4 years and 7 months. And then momentum for TDVL issued has been maintained. And then the negative is that there was a growth in rental car population. This came as a negative surprise as we were expecting a month-on-month decline instead. The reason is coming from the recent news in the media regarding Lion City Rentals putting up the cars for sale, and also the deadline for these private hire car drivers to get their PDVL has lapsed as well, and only about less than half of them have passed the test. Okay, so this is the chart for taxi and rental car population as well as their growth rate. So dark blue line shows that taxi population continues to contract, but the year-on-year contraction shows sign of bottoming. So this is where the growth rate, you can see, is starting. It looks like there's a bottoming already. For rental cars wise, that's the red line. So we've been saying for months that the growth in the actual population for rental cars is stagnating, and then the growth rate has already been tapering down. So right here, this is where, as I mentioned just now, this is the first time in 4 years and 7 months where it's dropped down to a single digit year-on-year growth. Previously, for the last 4 years and 7 months, the growth rate has been double digit. The chart on the left is showing the number of taxi licenses issued. So for the month of June, it's somewhere around here. You can see that it's sustained at about 350. So I think that anywhere between 300 and 500 is quite a healthy number for the number of licenses issued. The chart on the right is showing the number of valid license holders. So it has remained flat year to date. We will now move on to Ascendas REIT. So Ascendas REIT announced results last week as well. We maintain accumulate on Ascendas REIT, target price unchanged 296, and DPU, we're forecasting DPU of 16.13 cents. That'll give you a 6% yield based on last close price of 270. For other results wise, we have maintained the target price at 296, but take note that a day before the results was announced, we have already upgraded the target price because of the acquisition in UK. So now for the results wise, first quarter FY19 gross revenue was 1.5% higher. This was due to inorganic growth from contribution of their Australia acquisitions and redeveloped properties in Singapore, but offset by some divestments. They divested 3 properties. That's 10 Woodlands Link, number 13 International Business Park, and 84 Genting Lane. Net property income was higher by 3.8%, and distributor income was lower by 1%. Take note that last year there was a one-off distribution, so that's the reason why this year the distributable income is lower. At the DPU level, the unit base is larger marginally, and then DPU is lower by 1.2%. But if you exclude the one-off distribution from last year, then DPU would be 4% higher year on year. So what that means is that actually there has been growth in DPU from recurring operations. The positives, there was a positive rental reversion of 10.5% for the portfolio weighted average. And then WALE remains healthy at 4.1 years. This is above the sector average of 3.7 years. Also, they've increased the proportion of borrowings on fixed rate. So this will help to mitigate interest rate risk. Negatives is at lower portfolio occupancy, which was led by lower Singapore occupancy. And then quarter-on-quarter higher leverage of 35.7% from 34.4%. Overall, the outlook for A-REIT is stable. The portfolio is very large and is sufficiently diversified to cushion short-term localized impact. Now we move on to Cash Logistics Trust. So we maintain neutral, and we have cut the target price from 91 cents to 82 cents. And then DPU also forecasted lower at 5.65 cents. That will give you a 7.5% yield based on last Friday's close at 75 cents. So gross revenue was higher, 7.7%. This was mainly due to inorganic growth, where they acquired 9 warehouses in February this year, and then offset by some lower contribution. You see that net property, despite the increase in gross revenue, you see that net property income came in lower. The main reason why there's this divergence is because there was the conversion of CWT Commodity Hub from a master lease to a multi-tenancy lease structure. So that had increased property expenses since it's no more on a triple net. And then consequently, distributor income is lower year on year by 6.3%. Take note that in both this quarter and the quarter last year, there were a capital distribution. So this year there's a 408,000 capital distribution, and last year there was a 118. So if you exclude all that out, the underlying distributor income from recurring operations is actually 8.1% lower year on year. And then DPU is 21% lower year on year. This is the effect from the 19% larger unit base following the rights issue in October last year. So the positives is that gearing has been lowered from 38.5% to 35.3%. This is following the disposal of District Center 2. That's one of the warehouses. So they have used the divestment proceeds to pay off that. And then higher than expected occupancy at CWT Commodity Hub. So CWT Commodity Hub had converted around April, and at that time the occupancy was about mid to high 80s, and then now it's already at the low to mid 90s. So there was a positive surprise in filling up some of the space in CWT Commodity Hub. However, the trade-off was that leases signed are shorter than usual. Then in terms of forward-looking, there's limited vacancy risk for the second half of this year. They only have about 3% of leases due for expiry in second half of this year. Negatives-wise, NPI, that's net property income, is lower despite the higher gross revenue. So I've explained just now already that this is because of the higher property expenses associated with the conversion of CWT Commodity Hub. And then year-on-year lower distributor income is underpinned by lower underlying distributor income from operations. Take note also that in this quarter this year, they also have to make payment to the perpetual securities holders. There was no such payment in 2Q17. So that's part of the contributing factor on the lower distributable income to unit holders. And then finally, a portfolio rental reversion of negative 4% for the quarter. Outlook for cash is negative. Firstly, there's negative reversions, and this is expected to continue for the remainder of 2018, and that could actually flow over to 2019 as well. We think that that's a possibility. And then for 2019, they have about 28% of leases by gross rental income for renewal, and that's quite a significant chunk. You think about it, about 30% of, almost 30% of portfolio is expiring in 1 year. Most of it happens in the first and second quarter, and second quarter is the peak. So we'll be keeping an eye out on this. And moreover, they have 3 master leases expiring in 2019 as well. Okay, we'll skip the slides for banking and DBS as the analyst is not in today. So we'll move on to Guangzhi, who will talk about China Aviation Oil.
Hi, good morning. It's Guangzhi here. So next, we'll talk about second Q results update on China Aviation Oil. So last week, they announced the second Q results. We maintain our buy call with an unchanged target price of $2. So you can see here, both top line and bottom line grow substantially, especially the top line. The growth was mainly due to high oil prices as well as higher supply and trading volume of their oil products. For the bottom line, the main contribution was still the profits from associates and joint ventures. However, the second Q performance remained flat compared to last year's. So let's look at the positives. You can see the chart here, the total volumes of the supply and trading volumes grow by about 19%. However, for the volumes from middle distillates, especially jet fuel, dropped moderately. That was because the backwardation in the oil market persisted in the second Q. And for CAO, they reduced the trading activities, especially the paper trading on jet fuel. That is the reason why the jet fuel volume decreased. So for other oil products, the volume grew substantially. That was mainly due to more crude oil trading supplied to China, because the domestic refinery plants granted more quota to CAO, so they traded more crude oil for China. So for the margins, the supply and trading margins increased by 30.5% year on year to $1.64 US dollars per ton. And the negatives is, as I mentioned before, the growth of profits from associates and joint ventures remained flat. That was mainly due to less profit from Shanghai Pudong International Airport. So the flat was mainly due to the FS losses offset the growth in refueling volume. So and also for the profit from OKYC, it grew substantially to $2 million US dollars. So for the outlook on CAO, we do remain upbeat on this stock. However, we think that the trading activities will be slower for the rest of this year because we think the backwardation may continue. And recently, they acquired another refueling company in Europe, and we think that we will see the positive synergies from this company called NAL next year. So basically, we will see the profit contribution from this company in 2019 onwards. And another catalyst to look forward to is the fifth runway in Shanghai Pudong International Airport. As of now, the utilization rate of the fifth runway was low. So next year, we expect the utilization of the fifth runway will increase, because right now the rate was about 40 to 50%. So that means next year, if the air traffic volume in Shanghai Pudong International Airport increase, we think that the more refueling volume will translate into higher profit contribution from Shanghai Pudong. So we are still a bit on this stock.
Hi, thank you, Guangzhi. So this is Samuel from Phillip Futures. I'll be presenting on the central bank outlooks that released their results last week. Just hold on while I load my slides. Hi, a very good morning to everybody. So this is Samuel from Phillip Futures. So today I'll be actually presenting on the central bank meetings and the update on policies. So before we begin, just a little disclaimer. It's just that everything that we said today will be solely for education purpose and does not constitute to any form of financial advice. So on. So last week we actually saw a series of central banks that released their results, of which impacted the currency as well as markets. So we can see on Tuesday itself, the Bank of Japan actually announced, followed by Wednesday, the Fed, the US side, as well as on Thursday is the Bank of England. So we can see that all of this actually impacted markets. So we analyze what actually happened during the meetings itself. So for the Bank of Japan, what happens is that before the run-up to the meeting, markets were quite fearful of the Bank of Japan because there were a lot of words on the street. They were saying that they are going to revise the monetary policy methods. So it includes the methodology on how the BOJ actually buys back the shares. So as we all know, this buying back of shares, monetary stimulus is very important for Japanese markets as it keeps the yen low and sort of like benefits stock markets, the indices, in particular Nikkei. But what happens is that over the period of monetary stimulus, it has caused a lot of the Nikkei companies to have the top 10 shareholders. One of it will be the Bank of Japan. So it caused worry for markets. So what happens is that during the meeting itself, they actually stated that they are not actually lifting cooling measures anytime soon. It gave more weakness to the yen. Also, they stated that they are actually going to change the methodology a bit, so it gives more policy flexibility and it helped stabilize the Nikkei and stock markets as well. So because of all of this, we actually see that the yen actually dropped. So if you look at this is the US dollar yen chart, we can see that after the announcement in 20 minutes, it actually saw 0.48%. It means that the yen actually depreciated because it actually gave more confidence to markets that the Bank of Japan is going to keep monetary easing for a longer period of time, and it's going to benefit Japanese markets and keep the yen low. And for the Fed side, we can see that a lot of interest. So just our little projection. So if we look at the US dollar and yen pair, we can see that there's more upward momentum. It's above the 20, 40, 200, 100 EMA. So it shows that every time it bounces off, there's more upward trajectory. And the next resistance should be at the 50% mark of the Fibonacci retracement. So if we look at the Fed statement on Wednesday, a lot of interest was given to the Fed statement because people wanted to know how many times the Fed would raise rates. There's an increasing probability of the Fed raising rates another 2 times this year. And so people were actually tuning in to the statement to see what is the tone of the Fed. So the expectations is that there was no change in interest rate policies, which is pretty much in line. However, we noted that the Fed actually took a more hawkish approach. They stated that economic activity has been rising at a strong rate and it's more bullish than before. So they also have stated that the labor has constantly grew, household spending has risen, and it actually increases that probability of Fed raising rates another 2 times this year. There was also no mention about the President Trump's recent criticism of the Fed that they are raising rates too fast. He also had no mention towards the rising US trade tension. So actually it's deemed very positive and hawkish, and it points towards a higher probability of the Fed actually raising rates 2 more times before the year ends. So if you look at if we look at markets, remain relatively muted after the announcement because it was quite in line. But as it goes by, as people start to digest the more positive news, you can see that the dollar constantly strengthened. So because of all of this, we see that the dollar strength is still apparent as the Fed is still more hawkish than the other central banks. So more interest is garnered back towards the dollar. If we look at the technical analysis, we can see that the US dollar Sing dollar pair, it has actually ever since April itself, we can see that the US dollar has broken out of the downwards channel and strength has been very positive. So we can see that based on the moving averages, you can see that the US dollar Sing dollar pair is trending much higher than its moving averages and shows more bullish strength. And we think that the next meaningful resistance will be actually the 61.8% levels. So for the BOE on Thursday itself, people were expecting that the pound is going to rise because the BOE has hinted that they are going to raise interest rates by another 25 basis points, of which they did. However, what went against people's expectations is that the governor actually signaled that there was no hurry for a next rate hike, and that one rate hike in 1 year is actually a good rule of thumb. He also noted that the negotiations are entering a critical period for the Brexit side, and that the BOE is prepared for all scenarios, but he gave no indication that policy makers will want to see an increase in the path of rate hikes. So what it means that he's still rather dovish on things. And we can see that Brexit fears actually still dominated sentiments. As such, we have the view that actually the BOE should refrain from raising any rates until the picture becomes clearer when they actually formally leaves Europe on the 29th of March next year. So we can see that as the time progresses closer to Brexit, what happens is that markets are getting more jittery and there's less strength in the pound. This is because if you look over the weekends, you can see that two important figures actually went out to say that there's a higher probability of a hard Brexit occurring, and this is due to the progress of talks so far. So all of this will actually lead to more instability in the pound. So if you look what's the market reaction after the announcement, you can see that for the first 20 minutes, it actually grew 0.31% because this was due to it fulfilling expectations that they were raising rates by 25 basis points. However, subsequently, in the next 31 minutes, all the gains were reversed. It dropped 0.61% due to the comments by the Bank of England itself. So if you look at our technical analysis, we can see that it's still a bearish trend. It's below the 4 moving averages, and the next meaningful support should be actually the 61.8% mark. So with that, I've ended the side on the summary of the central banks, and I'll pass it on to the Phillip Securities side. If there are any questions, please feel free to type it in the question box.
Hi, there's a question on Synergy and where does it stand compared to Y Ventures. So for Synergy, it focuses on body, beauty, and baby products. They achieve revenue by taking on inventory and on consignment basis. For Y Ventures, they get their sales from sale of books in the US, most of it, and Y Ventures have their own branded products. So that being said, both companies are competing in the e-commerce space in Singapore with different strategies. So I think it's also important to note that for Synergy, from what I understand during the pre-IPO briefing, is that the price of the product is set by brand owners. So this means that the margins are dictated sort of by the brand owners. Thank you.
Hi, this is Samuel from Phillip Futures. So we have a question on when is the European Central Bank releasing their updates. So it actually released 2 weeks back before the Bank of England, Fed, and Bank of Japan, and they have indicated that they are going to sort of like retain current monetary policy, make it status quo. They are quite still relatively dovish because even though they are going to lift sort of like their quantitative easing measures by the end of October, but we can see that their projection to raise rates, right, is actually the later part of next year itself. So actually all of this went against people's expectations, and therefore we can see slight weakness in the euro still going forward as compared to other currencies like the US dollar. So the next question is on the impact of rising interest rate on REITs. So I'll pass it back to the Phillip Research side. Thank you.
Hi all, Jeremy speaking here. So there's a question asking where is the STI heading next. So I think the closest way I can answer that is to look at what the charts are showing. So on the screen here, what we are seeing is the STI on a weekly time frame chart. So again, just to reiterate what we are seeing, at least on longer term basis, is the STI is definitely still within a long-term uptrend that began somewhere back in 2016 February. And more interestingly is this most recent correction that we've seen since April. Once it tested this high of 3641, we have seen STI kind of moving into this correction phase for the past 3 months or so. But more interestingly is with the recent price action that we see that some signs that the bulls are kind of building back some strength here. And more importantly is how the buyers are kind of holding up at this critical support level. And what I mean by that is you can see this critical psychological round about 3,200 points. That by itself is pretty interesting because for the whole of 2017, we have seen how buyers have actually kept this support level intact pretty nicely. And every single time when we tested this 3,200 psychological round number, what we saw was strong buying coming back into the market for the STI. And you can see the most recent one in September. What happened was this minor correction over here was strongly kind of halted by the 3,200 psychological round number. And subsequently, we see a strong move back into the uptrend. So coupling that with what the Fibonacci retracement levels are showing, we can see this 3,200 psychological round number kind of coinciding with this 50% Fibonacci retracement level. And all in, it's kind of affirming that this support level is pretty strong. And more importantly, you can see there's also a 200-week moving average that is also kind of keeping a support for price. So all in, there is kind of a strong support here, three confluence in terms of static support at 3,200 points, psychological round number, 50% Fibonacci retracement level, as well as a 200-week moving average. And all in is the reason with that strong support, we saw kind of some reversion in price happening for the STI somewhere in early part of July. And you can see the price action bouncing off that level kind of tells us that the long-term uptrend for the STI remains pretty solidly intact. And looking deeper into what the relative strength index is showing, the bottom panel over here shows you the RSI. And interestingly, with the sharp sell-off for the past 2 to 3 months, the RSI has also dipped into the kind of oversold territory at 30 somewhere in early July. And since kind of tagging the oversold region, the rebound higher has kind of confirmed that we are seeing the start of a mean reversion higher for the STI, at least on the RSI perspective. So all in, right now, in terms of price action wise, we are seeing this 3,200 psychological round number holding up. And immediate term, probably some resistance is coming into play here at this 3,341 points. Mark up these 3 points over here to show you why this resistance is kind of important. And the most recent price action, we saw some wobbling price action, at least from a buyer's perspective, around this 3,341 points. So in order for the uptrend to continue to move higher, more importantly, we need to see further strength for the STI to kind of break above this 3,341 support time resistance level moving forward ahead. And all in, as long as the 3,200 psychological round number holds up, we believe the STI, at least on the longer term perspective, the uptrend remains intact. And once we break above this 3,341 resistance area, we should expect the STI to continue with the bullish momentum to retest this 3,460 resistance area, and after which to retest the 3,600 points.
So about DBS, because I just came back from the OCBC results briefing, so let me briefly go through DBS Group Holdings. So we have upgraded our calls from accumulate to buy, and our target price is now 33.32 as compared to the last price 32.7. So mainly for DBS, it is NIMs that is the strong growth driver. So NIM actually touched 1.85%, expanding 11 basis points year on year, and this is the highest in 7 quarters. So this, of course, we all know is driven by the higher SIBOR and HIBOR rates. So the management actually guided 1 to 2 basis points above the previous guidance of 1.85%. And then also net interest income did well. It was driven by broad-based loans growth, and loans growth was strong at 11.5% year on year, and this was driven mainly by building and construction, housing loans, and also loans to financial institutions. So even though we see a rising interest rate, but housing loans still grew quite well. It went to 14.1% year on year. And DBS market share of the Singapore housing loans remains quite strong at 31%. So Hong Kong's also did well. Net interest income grew 28% year on year, and also this benefited from rising interest rates. And with the rise in HIBOR, it became much more significant, this benefit from the rise in HIBOR with a growing CASA base, and also loans growth was robust at 12.3% year on year. However, for the negatives for DBS would mainly be the treasury market. It actually missed the mark quite badly. It's the first time that it actually made a loss since Piyush went up as the CEO of DBS. And the revenue from treasury markets declined 58.5% year on year. So the poor performance resulted in a pre-tax loss of 50 million as compared to a profit in previous year's 2Q17. And also there was lackluster performance from non-interest income. So based on what the management said, this was mainly due to a flattening yield curve and also wider credit spreads due to trade tensions. So for our outlook, for the recent property cooling measures, management is also advising a slowdown in housing loans and also property-related business loans growth. And trade war tension is also anticipated to have an impact on trade loans as well. And the spillover effects have already been seen in the weaker treasury market's performance this year. So despite the softer expectation of loans growth due to market headwinds, net interest margin will still be on a positive trajectory, and the trade issues will mostly impact trade volumes rather than the margins. So all in all, we raised our target price to the 3.32%, and this is mostly because of a higher book value assumption. Our valuation model still remains the same. Yeah, that's it for DBS. Any other question about DBS?
Hi, if there are no more questions, we'll end the webinar for this week. Thank you for tuning in. See you next week.